So finally, we're in episode 5. We're almost ready to start developing our own trading style and develop our first stock portfolio. So stay tuned. Hey, it's David Hill again. Welcome to The Wealth Warrior, where we demystify investments and tell everyone how to become wealthy very, very simply. Now, in my last episode, we talked about some of the traders on Wall Street and some of the great behaviors that they learned over time and all of the lessons learned. In this episode, we'll turn it around a bit and we'll start looking at the actual fluctuations in the market and some of the best times to buy. You know, when are the best times to pounce in on great deals in stocks? Timing can be everything. Now, if you let your emotions rule, panic can set in and you can consider selling everything. Just remember that panic is not a strategy. You have to look at the business fundamentals underlying the great companies. Now here are a few more tips that relate to present day conditions. Despite all the fireworks in Washington, the election really didn't matter to the market. Technology is the winner every time. You can't go wrong with companies like Apple and Microsoft. This is no technology bubble like the 1990s. Technology companies might be a bit overpriced because they continue to register record earnings regularly. In the 1990s, the companies were actually empty shells and they had no revenue to back up the overinflated stock price. Stocks were too high. There are some companies that continue to deliver really high numbers. Many stay-at-home economy plays are really doing quite well, and ones you might not expect. Now, I mentioned technology companies like Apple and Microsoft, but it's also companies like Home Depot, Walmart, and Target. With the numbers going up, people will still be buying groceries, they'll still be getting essentials from these stores, and the stock price will go up. Sell everything? You know, God, no, don't sell everything. This is ridiculous. We are on the precipice of one of the greatest economies the world has ever seen. Yes, employment is down. Yes, we're recovering from a recession, but we're just starting to come out of it. We'll see an unprecedented growth in all economic sectors for at least the next 5 to 10 years. So if you remember from my last episode, when people are selling stocks, you're doing exactly the opposite. You're buying stocks because people are panicking. You're buying stocks cheap. Panic is not a strategy. So assess the economic landscape and look for deals out there and invest in those deals because those stocks will grow in the coming months. Hopefully by the end of this course, one of the things that we'll do is we'll maintain 5 to 10% in cash, and we'll be able to take advantages of times like these. So stocks are kind of wavering and they've gone very sideways in the last little while, but this is the time where you need to buckle down and invest. So there's actually quite a bit to cover here, and bear with me, but we're going to go through some of these ups and downs of the market. Now, it's really not a secret that investors have to buy low and sell high. But, you know, what are the subtle increases and decreases in the market and our chances to really take advantage of what's going on? So I'll go into each of these in a little bit of detail. Okay, here are the areas that we're going to focus on. Number one, we're going to look at cyclical stocks versus value stocks. Number two, we'll look at opportunities with earnings misses. So every quarter, stocks report their earnings, and sometimes they miss these earnings. It's a great time to buy. Number three, an underbought or overbought market. What's the difference? How do we tell? And when can we take advantage? Stock consolidation, what does it really that mean? Is stock consolidation a reason to panic? Strong pullbacks, what are strong pullbacks? Next, the VIX, or Dreaded Fear Index. And how can we use it to assist with our trading decision? And finally, recessions and depressions. Now, what does that mean? Can we predict them? How do we prepare? Can we protect ourselves from them? So I'll go into detail with all of these. Okay, first up, let's talk about cyclical stocks. Now, cyclical stocks, they take advantage of the economy when the economy is just starting up. So we can kind of predict when the economy is ramping up, and some stock categories that are really great to buy at those times. They mostly fall into the consumer discretionary or the industrial sector. Now, industrial is quite obvious, but consumer discretionary can be described as these are companies we deal with when we have extra money. So let's go into a list of a couple cyclical companies. Typical stocks in the cyclicals are cars, homes, construction, railroads, airlines, hotels, restaurants, and travel. Briefly, let's talk about, what aren't cyclical. So stocks that fall into this category are consumer staples and utilities for the most part. So let's go into a couple of these. So some of the best non-cyclical stocks right now are those associated with basic things like groceries, toothpaste, water, gas, and electricity. These are really essential items that we buy all the time no matter what, whether the economy is going up or down. So they actually hold up very well during recessions. These can be considered value stocks as opposed to cyclical stocks. Okay, let's talk about our second option, earnings misses. Now, every quarter, that's once every 3 months, companies report their financial results down to the number of cents. Here's a snapshot of the NASDAQ earnings calendar, which shows you the companies that reported earnings last week. Large Wall Street brokerage houses hire an army of analysts to estimate what the corporate profits for each company will be in terms of earnings per share and revenue forecasts for upcoming quarters. So exactly what are corporate earnings? Well, earnings are how much the company made after taxes. This is also called net profit or net income and is the company's bottom line. Each quarter, Wall Street analysts try to predict a company's earnings per share or EPS. EPS can be calculated by putting the net profit over the number of shares to provide an EPS ratio. However, if the actual earnings is lower than the estimate, for example, if the estimate comes in at $2.46 per share and the actual EPS is $2.17 per share, in this case, there is an expected surprise prediction of lower than 11.8%. This will usually result in the stock price dropping, giving you a great buying opportunity. Now, if you want to find the earnings date of your favorite company, you can use a web address listed below. You would substitute the company's ticker symbol with the stock symbol shown in the address. So, for Amazon, you would type the following web address, putting AMZN in where the stock symbol should go. You would get a similar earnings announcement to the one listed below. There are a lot of foolish investors that actually shed shares of great companies. Either that or there's some computer somewhere that's actually selling stocks automatically because the stock went below a certain price. Now, to me, this is ridiculous. If it's a great company, as soon as the stocks fall and it's an earning miss, buy those stocks. That's a great time to buy them when they've taken their little bump. So, to prove my point, Netflix reported earnings in early October. They actually missed their earnings and the stock dropped dramatically. Here's the graph. So, why should we buy Netflix at this particular time? Why is Netflix a great company? Well, it's got a great growth record. And actually, if you think about it, the pandemic shows no sign of stopping in the short term. Okay, let's look at the next category, which is underbought and overbought stocks. Actually, when earnings are expected to reach a certain point, but the value of the stock is quite low, that stock is said to be underbought. And in future episodes, I'll explain how you can actually determine if a stock is underbought or overbought. Now, overbought stocks are stocks that actually investors love. Two names that come to mind are Apple and Tesla. Investors love these stocks. They're growing really fast, and they're growing so fast that investors have anticipated growth in the companies. So they've actually overbought the stocks, and they're quite high right now. Those are probably not the best stocks to buy. It's probably better to wait until the stocks drop. So when I first filmed this episode, the stock price was really high. Well, in the last couple of weeks, fast forward to today, the stocks have dropped significantly. So this is actually a good time to buy. So to understand overbought and underbought a little bit more, let's talk about a stock that's been really hot of late called Solar Edge, abbreviated SEDG, Sedge. To sort of look at this in closer detail, I'm going to draw on Peter Lynch. I talked about Peter Lynch in my last episode, and he actually has been so successful, there's a chart named after him, which he used to actually determine the value of stocks. So let's take a closer look. This chart then tells you the best times to buy this stock in red to ensure great stock value and return. As you can see, this stock has become overbought now since the price is very high.
In blue.
Not a buy for me here.
Here's another example from the website Guru Focus where it shows the price in blue, and the price is still way above the expected value of the stock. The value it's overvalued for years to come. You can see the years there, 2000. It's even more expensive than it probably will be in 2024. So it's very overvalued.
If the stock's already high, you miss the opportunity. So people were anticipating this months ago and they started investing in this stock. Now when the stock drops, we have to take advantage of it. So what I like to do is say, okay, move that particular stock to my shopping list. So let's look at it again and keep an eye on it, and when it drops, we'll pull the trigger on it. Now let's briefly talk about stock consolidation. Stock consolidation happens when the market moves sideways. So especially with a particular stock, the stock price doesn't go up or down. It kind of goes up some days and down some days, and it goes sideways for quite a while. What does that mean in terms of buying a stock? So let's look at this graph. This is a great web company called Coupa. So as you can see, the stock has been going sideways and it's resting right now. So we're waiting for the next leg up. Now there are a couple of periods when a buy of this particular stock would be great, and it's shown on the graph here. Another great example of consolidation is Apple. We know that earnings of this company are great and we'll expect big things from it. Now the next term we're going to learn is pullback or strong pullback. You'll see actually great companies that perform well will actually pull back their price because they've become overbought. Now here's a good example from a company called NVIDIA. NVIDIA is amazing and it's growing very quickly. It makes chips for things like manufacturing, gaming, infrastructure, smartphones, and self-driving automobiles. This company is actually growing so fast that the price is getting ahead of itself. So when the stock begins to pull back, it's a good opportunity to pounce and actually buy the stock on its way down. In the stock world, you'll probably hear the term buy the dip. Okay, let's talk about another term called market correction. Now, market correction isn't based solely on one particular company. It's based on the entire stock market, and anything can trigger this. So if you look back, the market took a bit of a dip. Well, that's because there hadn't been a recession in 10 years and investors started getting panicky. You know, why hasn't a recession come? They weren't looking at economic data. They were waiting for the market to jump down and there was no apparent reason, and everyone panicked, sold their shares. Well, I took the opportunity at the time and I actually bought a lot of shares. So we should just sell during those market downturns. I say, well, you know, if things are starting to go down a bit, maybe lighten up on some of your stocks, but I wouldn't sell them. I would just buy.
Okay, let's move on to the VIX or volatility index. Although trading in this index is not recommended for beginners, it can be used by anyone as a market's fear index, which basically indicates the level of uncertainty of investors over the next 30 days. The VIX tends to peak when market uncertainty over stocks is at its highest. Ideally, you want to buy stocks at the lowest price or when the fear index is at its peak. However, it's impossible to predict a stock price bottom. So how do we trade these spikes in the VIX? Well, the safest way is to buy after the VIX returns to, say, below 25. You'll notice, however, that these are not the lowest prices. Another way is to nibble away at stock prices as they get ridiculously low and buy small quantities if the market goes lower. You might be safe to start taking a position in a stock when the VIX is, say, over 30, and keep buying small quantities at bargain prices as they creep lower. So here's a recent example showing recent VIX numbers. How would you trade it? When the S&P experiences these dips and the VIX is very high, I recommend to go to a site like, say, CNBC's US Market Movers. That's https://www.cnbc.com/US-market movers and look for high quality companies on your shopping list. Here's the list from Friday, March 12th, 2021. Here we can see that some of the top companies have really taken a beating. To name a few, Ulta Beauty Inc. sells cosmetics and skincare brands. Lennar is the largest home builder in the US. ServiceNow, one of the fastest growing cloud companies in the US. Alphabet, also otherwise known as Google, is one of the FANG stocks. Applied Materials supplies equipment, services, and software for the semiconductor industry. There's a real shortage right now with semiconductor chips. So looking at this list of stocks that have taken a beating, let's take a look at one of them. So let's look at ServiceNow. Well, this fast-growing stock has been dipping as of late and is well below its trend line in the last year, shown in red. I would say this is a buy, and actually I have bought some over the last couple of weeks.
Finally, let's talk about the last category, recessions and depressions. Now, recessions and depressions come along and they can be triggered by many things. If you actually look at the following graph, you'll actually see that the market has gone up and down for various reasons in the last few years. It could be the financial economic crisis, it could be oil prices spike, it could be COVID-19. So there are a lot of reasons that the market can correct. Let's go over some of the most recent downturns in the economy. Here's my list and the various years associated with the various downturns.
The latest recession was caused by the COVID-19 pandemic. However, it didn't affect online businesses. As a matter of fact, it actually helped some of them grow.
If we look back to 2008 and 2009, the financial crisis created a contraction in the economy. And this was from housing sales, which cascaded into all kinds of savings, and all kinds of banks went bad. In the late 1990s and 2000s, the famous dot-com bubble burst, and many tech companies were vastly overbought. So actually the market tanked at that time. In the early 1990s, the cause was a rapid rise in inflation.
Now here's a recent grasp, but let's get serious, folks. The inflation right now is only a little over 1.5%. Historically, inflation has been a lot higher, and as a matter of fact, the Federal Reserve's target in the U.S. is 2%, so we're even below that. So this recession fear is a little bit unfounded right now.
So you can see there are many causes of a recession or depression. We can't predict it, but there's definitely some things we can do to protect our investments. So here's my list of the best ways to protect your investments for recessions. Number one, the market's always going to go up. So protect your investments by keeping most of them in an S&P 500 index fund like Vanguard's VFV or other funds.
And here's a chart that shows some of the most popular S&P 500 index funds.
Number two, always keep 5 to 10% of your assets in cash. This way, when stocks have bottomed in a recession or depression, you can always buy a lot of them at discount prices. So as the market goes down, you should be considering buying. No one can actually predict the bottom, but if you actually buy gradually as stock prices go down, it's a good time to invest your money. So number three, if a recession or a depression has been a long time in coming, you can expect maybe a little market paranoia. Now we can't predict if a recession or depression will come, but we can say, okay, well, is there a chance for inflation? And inflation can be a reason for extra caution. So be cautious when inflation is over 5%, especially. Number four, take some profits and be wary to buy more stocks at inflated prices. So if prices are skyrocketing, like some of them have skyrocketed now, and you can lighten up on some of these. So Nvidia had gone up, say it had gone up, take some profits. Lastly, number five, never panic, sell your stocks. Stocks will always recover, and panicking means you basically sold your stocks at a low price, and panicking is definitely not an investment strategy. So is there a way to actually predict a recession or depression or a strong market correction or pullback? The answer is no. There's no way to predict it. Actually, in future episodes, I'll go into more details about some of the factors that offer a high risk that a pullback or recession will come, but there's nothing definite. So if all economic factors are great and the economy is full steam straight ahead, there are no reasons to actually fear a recession. So there really isn't one on the horizon right now. So we've talked about some of the things that you can do to protect your portfolio, but what are some of the boots on the ground kind of stock advice that can be given about various pullbacks? Okay, so let me go into some details. Okay, like I said, keep 5% of your portfolio in cash, especially if there's been a lot of investor exuberance and there's stocks prices are driven up. Lighten up on some of those stocks, and then you can probably buy them back at lower prices. When things do drop, keep an eye out for good companies. And I'm saying the FANG stocks are really great. And in particular, I really like Apple and Amazon, and Microsoft is another one. And I guess I can say those names till I'm blue in the face, but we know those stocks are really well run and the stocks are going to go up. Okay, in a recession, all prices are usually really low, so you can take your pick on the best companies. So choose good companies that have good growing stock price, and you can also purchase some stocks that might have great dividends. Utility stocks generally have really good dividends, and some real estate trust stocks have really good dividends that you can buy. Also, in a recession, you know that what's going to grow is going to be companies like railroads and chemical companies and Honeywell, which is a defense contractor growing into aerospace. So all of these companies we know will grow once the recession is over. So as the recession is happening, those stocks are good to load up on because we know they will grow when the economy ramps up again. These are some of the cyclical stocks. Other things that we might consider buying are things that are going to thrive in an economy in the travel sector. So a favorite of mine is Delta Airlines, DAL, or Southwest Airlines, LUV, great run companies. We know those will grow, and actually some of these companies will grow sort of post-recession, post-COVID recession. The market always recovers through wars, depressions, 9/11 attacks, or the financial crisis in 2007, 2008. The market has always come back. So this is another good reason to stay away from risky investments. Invest in good companies, and companies will always come back. And don't panic sell. Never panic sell. I mean, I can't emphasize that. I've said it so many times already. So as we wrap up this episode, I want to reiterate that we can't predict the ups and downs of the market, but we can prepare. We can be ready with cash when the opportunities arise. So stay safe, and I'll see you in my next episode.